Hey, everyone, I'm just testing my audio here. Can everyone hear me? So welcome to the first Q&A session. And if you want to participate, just leave a comment in the comment box and I'll answer them one by one. Let's see. Just gonna test my audio here. Testing my audio. Testing. Testing my audio. Okay, good. So I think the audio is working. All right. So if you want to ask a question, you can just leave a comment in the comment box. Okay. Live chat. It's kind of weird how I can't see the participant list. Okay. So if you're here, you can just say hi. Oh, hey. Hi, Daniel. How are you? Hi, Craig. Great. Okay, now I see. Now it's updating. So welcome to the live Q&A call. You can ask me anything about investing. So right now this is a pilot, but I think the plan is to have it once every week or once every 2 weeks. We'll still do our regular investing accelerator recorded calls. So So how's investing going for you guys? I think for Craig, I haven't heard from you for a while. So Daniel, what's your thoughts on the markets? People saying that the yield curve is inverting. So if you're looking at S&P 500, and if I pull up the chart here, you'll actually find out right now it's quite high. So one of my students is actually looking into investing in S&P 500 as an ETF fund. And if you're looking at S&P 500, it's quite high. It's near the top of the Bollinger Band. So it's not a good time to invest in S&P 500 itself. But based on the investing accelerator approach, it is based on specific stocks. And when the problem arises in the stock, then it naturally goes on discount. So I think you want to be extra careful when S&P 500 is at a high, but then you also want to look for discounted opportunities. So if you see a discounted opportunities, you just want to be conservative and see if S&P 500 is retracing, the discounted opportunity might be even more discounted than before. Craig, I've finally got some savings together and have opened a new account of TD Ameritrade. Do you think there are any good opportunities right now? And I think the answer is yes, Craig. So during our regular weekly coaching call, we covered quite a few stocks. For example, I think Intel is something that you can look into. In the next month or so, maybe in August or September, there's going to be an opportunity. If you are looking at 3M, right now is cheap, but I think it's still forming a bottom. So it's still early in terms of 3M. For NVIDIA, it's still in the entry zone. And depending on your appetites, you can wait for it or you can just enter within this band if you have a positive view on NVIDIA, a graphics card company. There are a couple of other stocks I'm also watching, but then I think management themselves are selling it, so then you want to be extra careful. So for example, Tiffany & Co., the ring, the jewelry brand, and also Box.com, which is kind of like Dropbox for business. So these two you can also look into, but then you want to be careful because management is selling it. Yeah, you're welcome. So I'm just monitoring the chat with my phone and the computer right now. That's why I'm always looking down. Daniel, do you think it's too late to get into Google right now? As last week it took, like price was around 1,080, but now it's at 1,131. I feel like I missed out on it. Okay, let's take a look then. So let me pull up the chart for Google. So if I'm looking at the chart, I'm actually looking at a chart for Google right now, and it is a pretty tough stock to get into. A couple of reasons, because it doesn't really dip into the red and the blue range very rarely, and then you actually see a pin bar like 4 weeks ago on June 3rd, 2019. I do feel like we need some sort of share screen function so you can see what I'm seeing. But anyways, I think a better way to look at it is actually look at the insider activity to see if it supports um, the bottom. So I'm just pulling up the insider activity right now. Huh. Okay. June 26. Okay. So if you're looking at the insider activity, then you'll actually see that the CEO of Google, Sundar Pichai, that's my best pronunciation, actually bought quite a bit on June 26. So that's actually last week, last week, I mean. And then after the week where he bought a bunch of derivatives, then you see that the stock price start going up. And then you'll still see a little bit of sales. Let me take a look. You still see a little bit of sale. Actually, there's quite a bit of sale in June at 1,100. Okay, so I'm going to take back what I just said. Because if you look at what's happening with the insiders, you'll actually see that he bought around 1 million in terms of options. And then at the same time, he sold 10 million in terms of options. And then the CFO has been selling as well on June 25th. Let's see. So ignore that. Sunder. So I guess what you're getting right now is a mixed signal for Google when you're looking at insiders. Because you have the CFO selling at 1,115, you have the CEO also selling in this range, but then he's buying back a little. But when you compare the amount, it's still an overall sale. So if you want to enter at 1,132, I think it will be considered to be high. Yeah, I'll consider that to be high. And if you're looking at the range for the bottom, you're really looking at somewhere between the price today, which is 1130, to the bottom of the pin bar, which is 1030. So that is really the range you're looking at for Google. So I think if you wait, let's think about it. I think you have a 50-50 chance of Google coming back down to where the red EMA is, and then you'll be able to enter. Let's see. Yeah, or you're going to be trying to aim at 1,100. You're not getting a lot of discount, though. I think that's the key consideration. And if you're buying stocks and not stock options, it will be quite expensive. Yeah, so right now you're getting a 12% discount if you're getting into Google today. So ideally, it can be a little bit more. So let me know if I didn't answer your question, Daniel. Okay, Lee. Welcome, Lee. The value investors hold the value stocks for longer than 2 to 3 years. Would you hold stocks such as Facebook, Alphabet, Amazon, or Netflix forever? Now, that's actually interesting because when I first started investing, I use shares and then I use options. And then now I use a mix between shares and options. So for example, let's say I'm investing in, let's just use Shake Shack for example. So for Shake Shack, initially a while ago, I invested in Shake Shack using options. And it was great. And then afterwards, I exited, and then Shake Shack came back, and I decided that, well, the expansion of Shake Shack is going to be quite long term. So then I decided to hold some shares for it. So then that's a combination of shares and option. So you can convert some of your position into shares later. Now, in terms of Facebook, Alphabet, and Amazon and Netflix, for Amazon, so for Amazon, Google, and Facebook, these are all great companies, and you would still want to enter when there's a discount. So for example, Amazon back in December 2018 was near the red line. That's when you would enter. And if you do want to hold some for long term, then you would actually buy shares during that time, maybe like 10% shares and 90% options for Amazon, and then you decide to hold 10% forever. Yeah, but when you are holding shares, you actually don't get the benefit of leverage, which option gives you. So it depends if you want to, so it really depends on your horizon. So for example, for something like Shake Shack, I'll be holding it for 10 years. That's my plan. So Netflix. Now, I actually excluded that stock earlier when I'm talking about Amazon, Google, and Facebook because I think these are fantastic companies that is very hard to compete. For Netflix, I know a lot of people like it, but when I'm looking at the financials, I couldn't convince myself to invest in a company. And then now Disney is launching its streaming services, and there's Hulu, there's Amazon, there's YouTube. And when you think about the market, Netflix had the first mover advantage, but I don't necessarily think it's going to be the final player. Yeah. And when you're investing in a stock for long term, Lee, you definitely want to check in every 3 to 6 months to just make sure it's okay. Okay, so Hitesh is here. So yeah, welcome Hitesh. Just listening. Would you share the screen in a way that we can follow you? Great question. I actually don't know how to share the screen. Yeah, I think initially if I chose a share screen Q&A, then I can actually do that. But because I didn't do that, right now it's just a webcam only. So Hitesh, next time I will look into the share screen version. Yeah. Okay. All right. Your question. Facebook is coming up with new cryptocurrencies. So what's your view in the short term? Let me pull up Facebook here. So Facebook, when you're looking at the chart, right now Facebook is near $200, which is close to a psychological resistance. In fact, The last time it was at 220 at the highest high, and it sharply came down. So you can see that it is definitely a psychological resistance, and previously it was a resistance as well. So you don't want to be entering at this range. And when you're looking at the Bollinger Band, it's actually near the top of the Bollinger Band as well. Now, you'll see that the Bollinger Band is expanding, which indicate that the stock price has the potential to go up. But when you are thinking about the balance of probability, you'll be investing at a premium if the price comes down. Yeah. So basically, you want to wait for some bad news to happen to Facebook and enter when it is cheaper, somewhere between the red and the blue line. So let me pull up the insider transaction for Facebook as well. Now, what's interesting is that on June, it's actually Cheryl though. On June 25th, you actually see that Cheryl is still dumping the stock at 190, but she's always dumping the stock anyways. Okay, here's an interesting one. So David B. Fisher on May 31st actually dumped 2 million worth of stock at $180. So right now it's 190 something. So if you're looking back at May 30 something, it's the previous high. So it can be an alarming sign. Yeah. And the chief accounting officer, Susan, on May 20th is also dumping the stock. So given that you're not really getting an advantage in Facebook right now, you wouldn't be entering into the stock then. Okay. So right now, this is the pilot Q&A call. And if you guys like this instead of the recorded one, we can do one every week or every 2 weeks or so. Then you can just come up. I'll block off 2 hours of my time, and then you guys can ask any questions you want. So let's see who else is on. For some odd reason, the participant screen is actually not showing up. Okay. Yeah, I couldn't tell who's on, but we'll just roll with it for now. So just type in the comment box if you guys have any questions. So meanwhile, I'll see if I can share my screen somehow. Maybe I can pull up my iPad just to give you a sense of what's happening. So Craig, we won't always be able to be here when you're live, so having a record of each stream will be good. Yeah. So after this session, I'm definitely gonna put the recorded version on a channel and a membership site, so you will be able to access it. So Lee, I've previously purchased Nove at the highest high years ago. At this moment, I lost more than 50% of this stock. Will you suggest that I should hold it or wait until it is going back up or just sell it? Okay, let's take a look at what this stock is. So it's a healthcare pharmaceutical company. And you bought at the highest high, which I suppose is at around $29. And now is Oh, actually, you only lost 50%, right? National Olive Well Vanco. Oh, okay. 1 second. Let me pull up the right stock, not the healthcare one. Okay. Oh, this stock is in a downtrend. So right now it's $20, and I suppose you got in somewhere at around 44. So that's how you lose 50%. Let's see. So many years ago. So after 2015, the stock has been dropping. If you're looking at the chart. Okay. Let's take a look at the financials for it then. 1 second. So I'm going to go pull up the financials in MarketWatch. Okay. So there's a giant drop in revenue from 2015 to 2016. So since I can't share my screen, I'll just kind of read out loud what I'm seeing, so then that'll help you out. So if you're looking at the financials, the income statement, annual income statements for this company, National Oil Well, then you're going to see that the sales is 21 billion in 2014, 14 billion in 2015, so it dropped by around 7, and then 7 billion in 2016 and 7 billion in 2017, which dropped by half again, and then now in 2018 it's increasing again. Okay, so Lee, do you know why the revenue dropped by 50%? Actually, it dropped by 66, or else I can just Google it. And then you'll see that since 2015, it has been losing money for 4 years in a row. And now the losses is lessened. So I really need to know what is the history of this company then. So if you're looking at a chart, the first problem is actually that is a downtrend. So that means the question is, if you want to exit back at a high again, do you foresee that there's going to be a change in trend? Because if there isn't a change in trend, then I think as of right now, if you look at the line, the highest it will go is around $32, and then you're going to encounter resistance. And right now it's near the bottom of the Bollinger Band. So you'll be getting out at a relatively low price compared to, let's say, 3-4 months ago. Okay, so let me see why it is dropping first. Okay, so National Oil Well is actually heavily related to the price of oil then, because it makes oil equipment. It's an oil equipment manufacturer, and yeah, and it's going to be influenced by the oil price. So the concern is that right now I'm just reading an article from Motley Fool, is that because the oil price is low, that's going to reduce the capital spending for oil and gas, so then they have less sales. And I guess that's what you see, because since 2015, you actually see a decrease in sales for the company. So right now I'm just pulling up the oil price 5-year chart. And let me just take a look. So since 2015, the oil price dropped. So in 2014, it was fine. And then in 2015, it dropped by 50%, the oil price. And then afterwards, it kind of stabilized somewhere between $40 to $80. But then you'll see that in terms of the business performance, it's still dropping. Okay. Unless somehow you have an expectation that the oil price will go up significantly back to 110, unless you have an expectation that it will go back to 110. I don't think the stock price will change the trend in short term. Because when you look at the supply and demand for oil, it used to be Middle East and Russia that generates the most oil and gas, right? But then recently there is a new refinery technique developed by the US that allows them to extract oil from oil sands, which is very difficult and expensive to extract oil from. So then now US is becoming the biggest producer for oil, and that is really the reason why the oil price is down by 50%, because because United States just keep producing oil without following OPEC, which is the agreement to kind of restrict the oil production, so then the oil price is higher. Now, let's look at this. So if you're looking at the insider activity, let's see, you actually see a bunch of directors being rewarded stock options. February 28th, the chairman, president, and the CEO sold 300K. Let's see what that is in terms of time. March, February 28th. So it was at the last high at $30. So this is a difficult situation because the trend is down and is driven by oil price, and yeah, but you can see that directors are getting stock options in May, end of May, which is right at the bottom. Okay, that's positive. All right. So this analysis took a while because I'm trying to get information from different sources. But to summarize, the trend is down. Right now is at the lowest low. The company sells oil equipment, so then it's driven by oil prices. And right now the oil price is just hovering between $40 to $80. The CEO was selling at around $30, and right now it's 22, and then they issue stock options for the board of directors. And I think a director also bought some options in the open market as well in June. So that's why you see there's like a 3-week tick in the stock price. Now, if you're looking at the net income of this company, you're going to see that the worst was 2016, where they lost $2.4 billion. And then now they're only losing 31 million. So they're able to reduce their losses to a much smaller amount. And that's positive. If you are looking at sales, I don't think there is a strong seasonality in terms of sales for this company. But you'll see that in March, it actually has a drop in quarterly sales. Let's see. So I think it's going to be a little bit counterintuitive. But then for now, I think you can hold on to it. Now, the reason for holding on to it is because when you look at March, you're going to see that there's a negative 77 million loss, which is what drove the stock price down since 2019 March. Okay. And if you're looking at the curve of profitability, you actually see that a lot of sale happens in Q2, which is June. So the June financials is going to be released in July, late July or early August. Yeah. And then afterwards for Q3 and Q4, not much is happening. So you might see a spike in the next 2 to 3 months because you have insider buying, you have the financials performing better, assuming it's going to be performing better. But then I don't think in the short term it's going to pass $30. So if the stock price shoot up somewhere above 25 and between 32, like somewhere between 25 to 32, then it might be a good idea to just get out of the stock and invest in something that earns you a positive return. Yeah, so that's the answer for you, Lee. I think you can wait 2 to 3 months to see what happens to the stock price. And yeah, wait 2 to 3 months to see what happens to the stock price. And then try to exit at a high within a downtrend instead of a low within a downtrend. That would be your best bet. Okay, Hitesh, in general, should we buy options when the IV implied volatility is low? Great question. So you should buy options when the stock price is cheap. That's because the strategy in investing Accelerator is about long-term options. So the first rule is actually buying options for a great company and buying options when there's a discount. So if there is no discount, there's no point in applying leverage to an investment because leverage increases your risk. And the risk is going to come from the stock price goes against you. So if you buy something that is 20% discount, then you're limiting your risk because the price already dropped by 20%. Now, for your implied volatility, what you're really referring to, I think, is when there's an earnings release or when there's a lot of volume in the market, the volatility for the stock increases, and that makes the option price more expensive. And I do agree that you should buy options once the madness is over, and you want to wait for the hype to die down. But usually when you buy a stock at a discount, you also get a lower volatility because people are not paying attention to it. Yeah, exactly. Yeah. So one way to illustrate it is, so this is talking about the Black-Scholes model. where if your stock price is going like this versus like this, the option will be more expensive in this case because it's more volatile. That's what you're talking about. And this usually happens around earnings. So if you want to, so if you see this and it is very volatile, then just don't invest during that time. So you want to wait for the volatility to go down. Now, when you're investing in the market, you have a stock price, right? Going up like this. Can you guys see? Okay. And then when it comes down, what you're going to get is an increase in volatility here when it is going down. But then when it is forming a bottom, it's going to be horizontal like that. And the volatility is actually going to decrease. So unless you somehow invest the day that the earnings is released, this period here is like 3 to 12 weeks. So this period of low volatility is where you would usually buy. And then if there is an earnings release during this part, that will spike up the volatility and make the options more expensive. Yeah, it's actually volatility. But you wouldn't be able to, okay, yes, you will be able to buy during an earnings release, but that will put you at a disadvantage. So you need to buy when it is at a discount, when it is consolidating like that, and use a long-term view on the market. Because when there's earnings release, there's people that trade before the earnings release, and there's like people that buy 2 to 3 weeks before the earnings release that start pushing the price up because they know that the company is performing well already. So then is disadvantage to trade in this zone, and you want to trade actually before that. And that's why we place a lot of emphasis in this stage, because we want to get comfortable with the drop. So that makes sense? So the answer is yes, we should buy during low volatility period, which is there. Yeah. Okay. So if you guys have any questions, just leave it in the comment box and I'll answer them. I just don't have a good idea of how many people are actually online here. I guess that's one of the things with YouTube. It's not showing me the participant list. Oh well, but yeah, to participate, just leave a comment in the comment box. Yeah, I get that too, but if I'm looking at it through my app, it actually says 3 people. Yeah, go ahead. So. What do you mean by the return rate? Oh, okay, you mean the target? So during the exit of a stock, besides looking at the return rate, are there other factors we should pay attention to avoid a sharp downturn? So the answer is yes. And there's actually 2 situations. So the first one is after a drop, you're going to be entering here, right? Okay. So after a drop, you're going to be entering here. Now, at this point, you can either refer to the price is back up here and then it suddenly drop, or it's going to continue to drop. Now, for this second part, this is going to come from whether you did your homework in the beginning. Because remember, you need to wait for a bottom. You want to wait for a bottom to form. So if you're too early, then there is a likelihood of the stock dropping a second time. Now, when something happens and causes the stock price to drop is usually unexpected. So the chances of something unexpected happening twice is quite low. So for example, the Boeing plane crash that we talked about a lot. Now, right now, Boeing is kind of forming a bottom here. Now, it's not exactly very cheap for Boeing, which is why I didn't cover it extensively for on our regular weekly coaching call. But essentially, the odds of Boeing having a third plane crash is actually quite low. So assuming Boeing is working hard to resolve the software issue for 737 MAX, then the companies will place order again once the regulatory bodies approve the airplane to fly again. So the odds of this happening is quite low. So now you're left with the other problem, which is here. When it has gone up, you're going to have two prices, right? One is your target price of, let's say, 100%, and another one is your break even. Now, this is a conservative break even point. So that means if the stock price already went to your break even point, then you are already in a profit. You're all good. So now it's just a matter of judgment to exit somewhere between 100 and break even point. Now, that's going to depend on your stock option expiry. And that's also going to depend on the candlestick pattern that you learned. Remember, I told you that there's something called like a pin bar that looks kind of like this. It's not very straight. So a pin bar looks something like this. If you see a pin bar, but the opposite version, then it also shows that the price itself is slowing down. So for example, if you see a pin bar like this, then it might be a good idea to exit. And if you see a Bollinger Band and it's really close to the Bollinger Band, or it's even above the Bollinger Band, so here's the Bollinger Band, and the stock price is above it, or really close to it, then you can also consider exiting. So these are other signals you can look for to exit. Now, ideally, if you're looking at exit strategy, ideally you want to exit before this downturn happens, which will be based on Bollinger Band, pin bar, the previous high, and this target price. So there's 4 ways you can look to see if you want to exit the market. And this needs to be done before the downturn happens. Now, so then I think the next question is going to be, well, what happens if there is this suddenly sharp drop? And this is where the time of the expiry of the option comes in, because when you're buying here, I told you to estimate how much time do you think it takes to come back up here. Now, the answer might be 6 months, the answer might be a year. And at that point, I told you to take that time and times it by 2. So if you think it will take 1 year to come back up to your target price, then give yourself 2 years. So the maximum time possible. So that will extend your time period. So if there is a drop, and assuming you got it at a discount here, you still have a lot of time to wait for the market to come back here again. So if there is a sharp drop, you have the option to wait. And if there is a drop, then perhaps you can even add into this position, assuming you did your research and you know that is okay, like the company is fundamentally sound and is performing well, and this drop is just irrational. So by doing this, you actually have enough time to wait for a drop and then come back up. So that should answer your question, because when it comes back up, you're just using the other 4 things I taught you. When it is down, you can either add to it, given you have enough time in terms of expiry. That's why this is so important, because this will be the key limiting factor. Yeah. So that should answer your question. So Hitesh, any thoughts around capital gain trading options, as it is very high? I know you're not a CPA. I am actually a CPA, but just thought of asking. So Hitesh, can you remind me where you're from? Are you in US, Canada, or another place? Okay, USA. Now, for USA, I think there's an account called Roth IRA, which is kind of like a retirement savings account. And based on my research, I think you can actually use Roth to trade options. So if you have a self-directed Roth that allows you to trade options, then that essentially deferred your capital gain. Yeah. And I think you only pay it once when you take it out in the end. But other than that, I don't know of any way to defer capital gain in the USA. I know there are 2 other strategies in Canada, but then, yeah, USA will be Roth. So if you have any questions, you can just leave it in the comment box. So Daniel asked, any thoughts on Goose, which stands for Canadian Goose, or Aritzia? So that's actually quite a good question. So let's talk about Aritzia first. So Aritzia is a Canadian clothing brand, and one of my students actually invested in it. So right now it's actually near the red EMA, and it's near the lower parts of the Bollinger Band. But I haven't looked at the financials yet. So let me just take a look at the financials. For Goose, I'll come back to it in a bit once I finish it with Aritzia. So because Aritzia is a Canadian stock, you're actually not going to get the insider analysis for it. Huh. Okay. All right. So revenue, Aritzia has been growing, and that's good. Gross income, same. Net income, Aritzia has actually been growing. So that is good. So one interesting thing about Aritzia is that it actually owns 3 to 4 of the luxurious retail brands in the shopping malls you see. So it's more than just Aritzia. It has like 2, 3 other ones. My female friends would know, but I don't know. They actually own a couple of brands. So then, even though it doesn't seem like it, they actually dominated the luxurious brands in shopping malls in terms of clothing. Yeah. Like Daniel, if you go to Metrotown and you see like the top 3 shops, I think they're all under Aritzia. Anyhow, so there's enough cash. Accounts receivables growing, that's fine. Inventory growing, that's fine. Property, plant, and equipment growing, that makes sense. Intangible assets is stable, makes sense. Accounts payable, it fluctuates, which is fine. Let's look at debt to equity. So when you look at debt to equity, it's actually less than 1-to-1. So that's not bad. That's actually okay. So it's around 255 divided by 374. So it's around 0.68 in terms of debt to equity ratio, which is less than 1, which is a good thing. So let's look at industry ratios. Daniel, do you know why Aritzia is dropping? Actually, an accounting friend of mine actually bought this stock a while back when it was $12, $12.25. So she got in at a cheap price. So I'm just trying to figure out why it is dropping now. June 28th. So we want to look at ratios. So if we are looking at ratios, you actually see that there isn't a lot of comparison when you're looking at investing.com. Because of that, we need to do something different here. Okay, because you guys can't see my screen, let me just write it out here. So Aritzia, P ratio, PS, P B. So here's 25. Here's 2.47. Here's 5.14. Now, on investing.com, it actually didn't give you a comparison, which is too bad. So we'll need to think of some comparison that we can use to compare with Aritzia. And one of the brands that I thought of is Nike, which is also a premium clothing brand. They have a stronger emphasis on shoes. And another one is Lululemon. That's a yoga brand, but then right now they're going into running. They're kind of sports related, but then Aritzia is more like luxurious clothing. It's like Forever 21, but the premium version. Anyhow, we'll just use these as comparable for now. So Nike is 35. So that's higher than Aritzia. Price to sales is 3.5. And then price to book is 15. Okay, so it's not exactly comparable. So here, for Lululemon, You're actually going to get 47 for price to earnings, 6.98, and 18. And this is a Vancouver brand. Okay. And if I'm searching up Lululemon, I actually found the industry comparables for Lululemon. And right now it's around 24. So this is industry. 1.65. And then 7.6. Okay, all right. So these are better comparables now. So this one is higher, this one is lower, this one is the same. So it's mixed. All right, good. So let's figure out why Aritzia is dropping. So Aritzia has been dropping since April. Let's see. Let's look at news. April. April 2019. So Aritzia it actually doesn't say why the stock price is dropping. I think I need more time to figure out why Aritzia is dropping. Okay, so I think it's related to earnings. Let me take a look again. So I think in November, the revenue is 242 million, and in February is 259 million. So then you do see an increase, but I think people are basically saying that it's not increasing enough. Because if you look at the previous 2 quarters, from May to August is 167 to 205, which is a 20% increase. From August to November is 18% increase. And then from November to February, it's only a 7% increase. So I think that is really the reason why it's going down. Yeah, I think that's why. Huh, okay. And then you do see a giant unusual expense of 5.7 million within the financial statements for February. So for Canadian stocks, you're not going to get the luxury of looking at insider analysis. So then the question is, do you think Aritzia has the opportunity to expand further? I think you need to look at whether Aritzia can expand further. And I think they're expanding in US. So I think that is okay. Yeah, I think they're expanding in US. So in terms of Canada, I think they're pretty much done in terms of expansion. They're in Toronto, they're in Vancouver, which is like the two biggest markets. So then where they can really go is really US. So I think the first thing is, do you think their US expansion is good? If you think there is, then the second question is, do you think their revenue will be growing again or growing faster than 7%? And I think the answer should also be yes. Yeah. So I think both answers are yes. Then you're looking to enter into the stock, which will be near $16, which is right now at $16.89. And the red EMA is actually at $16.50. So if you're looking at it, I think it's still forming a bottom. So you want to separate your positions into three. And right now you'll see the Bollinger Band expanding a little bit. So you might want to enter 1/3 at 17, below $17, 1/3 around $16, and 1/3 maybe 15.5 if you're lucky. So that's what I would do to enter into this stock. Yeah. So it's a similar idea as Intel. And right now you can see that the bottom is forming kind of a W that is higher than it. The right side of the W is higher than the left side of the W. Yeah. So your range right now is between the price today and the previous bottom, which is around 15.5. So you just got to separate your positions, so then you enter into this range. Okay, all right. For property, plant, and equipment, yes, definitely. And previously, I looked at it, and it is increasing. So it went from, one second. Let me change to annual financials here. So it went from 2017, 95, 2018, 135, and 2019, 167. So it is consistently increasing. And yeah. So it is expanding. So then the question is where? So my question is really, where are they expanding? So the question is where they're expanding. And I think the answer is US. So if you ever visit US and look at one of their stores, one important thing to look at is the Aritzia stores in US just as popular as the ones you see in Vancouver? And that would be a good comparison, because it might work fantastic for Canada, but it doesn't work in US. But having said that, though, I do think, yeah, so it'll be a good comparison to know. Maybe your wife knows. Okay, second one, Canadian Goose. So GOOS. Hey, it's dropped. Great. So right now there's a giant drop in May 2019. So that's definitely something you need to look into. GOOS. So let's look at the financials first, since that's what we have. By the way, Canadian Goose is a hit in China. People are crazy about it. All right, so in terms of revenue growth, there's definitely good revenue growth. And in terms of net income, it has good net income too, up to 2019. So if you look at quarterly, you're going to see seasonality for Canadian Goose, which is very popular in September and December. And right now we're in July, which is the opposite of their seasonality. So this actually creates an opportunity to enter into Canadian Goose. And then afterwards you have March. This year's March is actually better than last year's March in terms of revenue. So last year's March was 98 million and this year's March is 119. So in terms of net income, you'll actually find that they're making a loss in June 2018. So maybe in 2 to 3 weeks when they release the net income for June, you'll actually find that they're losing money, which I wouldn't be surprised. Okay. Yeah. Huh. So what's interesting when I'm looking at the charts is that if you look at last year, August, it's actually a dip. And right now you're in July, so that means you're in the dip area as well. Oh, yeah, okay. So in terms of income statements, I think they're fine. And right now you're at the point where you can actually take advantage of the seasonality. And if you look at cash, it's fine. AR, it's fine. Inventory doubled. Inventory almost doubled. So that actually increased a little bit faster than what I expected. So let's look at quarterly financials for inventory. So it went from 128 to 200 million. So if I look at quarterly financials, okay. So if I look at quarterly financials, you actually see that it is 200 million, which is a bit high, which can be a little bit concerning if the products are not selling, because they are a premium brand. So during times of recession, they're going to have higher amounts of inventory because they're not able to sell their goods. So property, plant, and equipment, they're expanding, it's increasing. In terms of debt to equity, it's actually less than 1-to-1 as well. So the debt to equity ratio is actually 0.45, which is quite good. So, okay. So the reason for the drop in May is because they missed revenue target. Their financial is good, their balance sheet is good. Their charts, there's a strong uptrend in terms of the chart. Actually, this trend is stronger than Aritzia. After the drop, you'll see that the bottom is around $32. And then the stock right now is around $40. Now, you don't have the luxury of looking at the insider activity for this company, but this is where the range for the bottom is. So if you're able to get in now, then you can actually be ready for this coming winter. Because the September sales and the December sales is going to be high. Yeah. But as of this week, I would still consider it to be high. So if you are able to get in somewhere below the red EMA, like around $36, $36.50, then I think that'll be a good price to enter. And you see that the Bollinger Band is expanding. So I think the odds of Canadian Goose shooting up right away without a retracement is actually quite low. Yeah, so look for that. Somewhere between the midpoint of $40 to $32. Like $36 will be a good price to enter. Okay, all right. Donnelly, DJ Donnelly, can you still get vitamin D from the sun if you use sunscreen? I don't know. Great question. And I was reading a book written by Tim Ferriss, 4 Hour Body, and they said if you are out in the sun for 15 minutes, you actually get enough vitamin D for the day. And anything more than 15 minutes is excessive. Okay, so bye, Hitesh. So Hitesh dropped off. So if anyone has any questions, you can leave a comment in the comment box to participate. We'll host this session for another 45 minutes, so it's around 2 hours long. Yeah. So I think so far this Q&A session is pretty effective. So yeah, I'll think of hosting more in the future. So if you have any questions, just leave it in the comment box. Meanwhile, I'll clear this. Okay, let me just grab something. See, stock investing is pretty simple. Huh. So if you guys have any last minute questions, you guys can put it in the chat. On a side note, I'm actually coming back to Vancouver. I'm flying in 2 days. So next time I'll find a way so that my screen is shared instead of using a whiteboard. So I think it actually works better if I host these sessions at night, like your nighttime anyways. So then once you get off work, then you can attend. So if you just got here, you can type in the comment box and ask me any questions. Ah. All right. So recently I've been reading a book called Stumbling on Happiness. And one of the things is that human beings come into the world with a passion for control. They go out of the world the same way, and research suggests that if they lose their ability to control things at any point between their entrance and their exit, they become unhappy, helpless, hopeless, and depressed. So then, oh, okay. So I think Ken is here. So unfortunately, Ken, I haven't figured out how to share my screen for this session. So I'll figure that out in the next session. And for Kenny Allen, for Kenny, you just need to leave a comment in the comment box. Yeah, if you leave a comment in the comment box, then I'll answer it. But I think you sent me your question already, so I'll just answer it. I don't understand options. Clearly, I understand leveraging, but not options. So option is actually a very complicated topic that I cover extensively within Investing Accelerator. So let's see. What is the best way to put this? So you'll get the full module in Investing Accelerator, but essentially, option is a form of leverage. And if you understand leverage, which you said you do, then you pretty much understand option. So you know how in a real estate, if you're trying to buy a house, right, and the house is $100, okay, then instead of paying for $100 with your cash, you just pay $20, and then the bank will pay $80, right? This is the concept of leverage, and this is a mortgage. Now, in the world of options, you just pay this. You just pay the 20 plus interest. Okay? So when you're looking at the mortgage part, this is already embedded when you buy the option. So you don't need to go to a bank to get a loan. You don't need to fill out mortgage papers or anything like that. As long as you just buy the option at a certain strike price, then that's essentially you paying for the down payment plus all the interest. So that is the easiest way to understand options. Now, if you go Google online and you actually search, if you search up options and how to value options, you're going to come across something called a Black-Scholes model. And it's a mathematical formula that will confuse you. It's a mathematical formula that will confuse you called a Black-Scholes model. Black-Scholes model. Okay? All right. So you don't need to go through this, and this is completely optional. Yeah. But if you're interested, essentially what Black-Scholes model is trying to do is you're ticking today, and then you're trying to compute what is the value of the option if it goes up or go down by a certain amount after, like, let's say a month, and then you calculate it again after 3 months, and you just keep going until the option expires. So let's say after this, the option expires, okay? It expires. I wonder if you guys can see it because I keep writing in a weird angle. So at this point, you know what the value of the option is, and then you bring it all back today, and you net present value it. If you're not familiar with discounted cash flow, it's just you bring these possibilities back to today, and you try to calculate what is the price of the option today, based on how volatile it is, based on, maybe this one is worth $0, this one's worth $100, and then you bring it back. And that's really what the formula does. But in order to invest using options successfully, you actually don't need to know the Black-Scholes model. You actually need to understand leverage and when to apply leverage. And you should only apply leverage when you are 95% sure you'll win. Yeah. So If you can't comment in the comment box, just send me an email because I'm checking my iPad as well. And if you don't know how to comment, I think you just click on the button here, and then there's a button called Live Chat. Then I think you should be able to leave a comment. Yeah. So for Ken, I haven't figured out how to share my screen, so I'll do that next time. I do have an idea on how I can share it. Maybe I need to use Google Hangouts. That's what it is. Yeah. So if you have any questions, leave a comment in the comment box or send me an email if you can't do it somehow. Okay, so back to the book I'm reading. So these people are studying happiness, and they actually ran an experiment on a group of elderly people. I don't know if it is legal, but apparently they did it. So they told half the residents that they were in control of the plants and feeding. So this group of elderly people have high control. And they told the remaining residents that a staff person would take the responsibility for the plant's well-being, low control. So 6 months later, 30% of the residents in the low control group, the people who do not water the plants, had died, compared with only 15% of the residents in the high control group. So basically, if you water plants, then you live longer. And this book is called Stumbling on Happiness. Yeah. So if you guys have any questions, leave it in the comment box. I'll think of a better time to host these sessions in the coming weeks. So I think it is pretty interactive, and yeah. Yeah. But if you are selecting a stock and you did your own analysis, make sure you submit through the form, so then I can look at it and I can do more preparation beforehand. Hmm. So great question. Daniel is asking, does your investing strategy change, or how would that monitor your trades if market does crash in the next year or so? So this is a great question because we are almost due for a market crash. The last crash was in 2008, and a crash is every 10 years or so. Now, here's what's interesting, I think, about this one. First, a lot of people have gotten smarter, so everyone is kind of waiting for a crash. Second, I think there are a couple of mini crashes that happened, and the stock market recovered from it. Now, remember during my weekly coaching call, I actually say, well, the Trump trade war, the oil price crash in 2016, and a couple of other things, like the trade war between Huawei and Apple. And I think these mini crashes actually delayed the big crash that we're all expecting. And when you're looking at the market, it's really mainly driven by two groups of investors, which is A, Americans, and B, the Chinese. And the Chinese market is not going to crash that easily because the government will not allow the market to crash because they will just keep pumping money into it. They're just not that public about it when compared to the US. Like China will say, like they will help with the stock market, but then they don't tell you how much money they're pumping into the market. So when you think about it, the crash is definitely delayed because of that reason. And if you have small crash, then the entire system itself isn't failing. Yeah. But there is some recent news in terms of the banks that are losing money, like DB, like the Dutch bank is losing money, so that can be a concern. So to answer your question, does my strategy change? So my strategy actually doesn't change. And I think it really comes back to the ultimate pattern. When you are looking at a discounted opportunity, you want to look at a couple of things, right? Which is A, why it is dropping. Now, if it is dropping because of, let's say, a bad video game from EA, then it really has nothing to do with the overall macro environment, so you wouldn't worry too much about it. So you can still invest in a company knowing that it will continue to go up. So if you see that there is a discounted stock because of a macro variable, like all the stocks in the market are dropping and the Trump trade war is affecting everybody, then you should think, well, maybe it will take longer to recover. So then you will wait a bit. Because until a bottom starts to form, you wouldn't invest in the stock. So this should give you sufficient time to see whether the stock is dropping more. So that's the whole point of waiting for a bottom to form. So one of the good examples is actually EA. Now, when you're looking at EA, here's what you get. It has been going up, and then suddenly it dropped once because of Battlefield 5, if I remember correctly, and then it dropped a second time. Now, this is because of the regulation change for loot boxes. So then you see the first drop, you see the second drop. Now, these two are all very specific to the gaming industry and to the company itself. Now, it will be different if EA is dropping because of this. Let's say the first drop is because a bank failed, like HSBC failed for some odd reason. And then the second drop is because a butterfly effect. Let's say HSBC failed, so some insurance company failed, and then now this price is dropping. So if it is because of these two reasons, you want to be more careful because it might just keep dropping to a cheaper price. But when you look at it, this actually doesn't affect EA as a company. So even if there is this crash, I would think that EA will start to farm a bottom sooner or later. It will start to farm a bottom sooner or later. So at that point, you'll actually evaluate, well, is it over? Is all the bad news out? Like at that point, you need to look at it because you are entering after the crash and you want to be waiting as long as possible. That's why I keep saying you want to wait 3 to 12 weeks here. So that should give you sufficient time to assess whether the market is dropping further. And that's why you break your positions into 3 so then you can assess whether it's going to drop more. Yeah. So that's how you would react during a market crash. It's actually very similar to EA. And when you think about it, a market crash, and if you enter at a low price, it recovers within 2 years. Sometimes it's 3 years. So at that point, if the stock is super cheap, then you actually want to use stock instead of options. But if you think it's going to recover a lot faster, then you can actually use options. But definitely that would be riskier. And if you think it's a crash and it suddenly turned into a downtrend instead of an uptrend, so it crosses over the 200 EMA, then you definitely want to wait more. So you want to wait more, and you want to use stock. Because when you use stock and you enter at like a 40, 50, 60% discount, it's a lot easier to wait and let the market sort itself out, assuming the company is fundamentally sound. So yeah, that's that. So if you just got here, um, oh, okay. You can leave a question in the comment box and I'll answer it. So how about my options that are actually already placed but haven't quite made much profit? Just worried if the market tanks, it will not recover in time and will run out. Any suggestions here? Roll out or just bite the bullet? I think that is a great question. And you really need to assess the reason for dropping. So you have two options, really. And it's really going to depend on the reason for dropping. Yeah. Now, let's say you entered here. And I've encountered both situations before. The first one was actually with Nike. And when I invest in Nike, I knew I got in at a discount. But somehow the market was just doing this. So then at some point, I only have less than 3 months left for my option. And at that point, it was really not enough time for the market to go back up like this. So then I had to exit at a small loss that's close to where I was, where I entered initially. Yeah. So because of the expiry, you'll actually try to exit as close to where you entered as possible. That is the first one. The second one is actually if you entered into the market and then you have 2 years and then it continued to drop. Now, it's important to understand why it is dropping. So this actually happened for Facebook when Carolyn entered here at the highest high was around 220, and here's around 150. So it's already a pretty good price for Facebook. Like $150 is a fantastic price. But during that time, the privacy scan was still happening, and it dropped to around 132. Now, given how strong of a company Facebook is, and Carolyn had 2 years, it actually makes sense to wait. Because later on, Facebook came back up and now is at $200 again. And Carolyn actually exited near $196. So it's really going to depend on your expiry. Now, if your expiry, instead of 2 years, you actually only have, 3 months, then you're going to be under a lot of stress because of how little time you have for the option. And that's why when we invest in companies like EA and Activision and Blizzard, I set the expiry to the maximum you can find when you get in, because we want to be prepared for this situation where you don't get the bottom exactly right and then you have time to wait. I think there is actually a third situation where there is a catastrophic crash like that. And in this case, it's really going to come down to when you initially entered here, are you right? And the second question is, are you too early? Because if you're wrong, then you lose money. It makes sense because, well, you're wrong. And if you're just entering too early, you actually have the option to add in your second and your third position here. Now, of course, you want to wait for a bottom to form, which is why I drew a horizontal line. Because if it is keep dropping, then you need to wait for a bottom to form. So either way, you need to wait for a bottom to form. Because if you'd say, well, Eric, when I enter here, I was wrong. And it turns out that the company had a fire. I actually entered into a company that had a fire, and it went bankrupt in 2 weeks. So then at that point, you don't do anything, and you just wait for the stock price to come up here as much as possible, kind of like what I told Lee, because she entered into a bad company with a downtrend, and you just try to exit at a relatively high point in a downtrend so you minimize your loss. That is the best you can do, because if the company is in a downtrend, which is actually the worst case scenario, then you need to minimize your loss by waiting for the next high. Yeah, and this will be a stressful situation, but that will be the best way you can play this. Yeah. So if you just got here, you can participate by commenting in the comment box, the live chat, and I'll answer them. So yeah, let me know if you guys have any questions. We'll be wrapping up this session in the next 10 minutes or so. So we have been live for 2 hours. Time actually flies faster than I thought when we're live. I actually thought 2 hours will be quite a long session, but it turns out to be okay. You know, I actually thought of an idea where I should put like a donation link, like those gamers, and collect donation. But no, I'm just kidding. We don't need to do that for this channel. So if you're unable to find the chat box for some reason, you can also send me an email, which is eric@5minuteinvesting.com. So if you have any questions, you can leave a comment in the comment box. Yeah. So, great question, Daniel. So what's my daily investing routine? Do you flip through your stocks list every day, filter through good opportunities first, and how do you find new stock ideas? Let me think about how to answer this question. So there's two modes. There's two things you really need to do. So the first one is you are 100% invested. I need to start writing horizontally. So first, you're 100% invested, and right now, or you're not 100%. Now, as of right now, I'm actually 100% invested. So every day, I just wake up, and when you look at my stock list, I have my holdings as the top 5 in the list. Okay? And then I just look at it for less than 5 minutes, like 2 minutes. I just click through it and see what the price is. So I'll show it to you on my iPad. So right now I'm fully invested, so it's very passive. So here I have the list of stocks. This is the TradingView app, and it's just up at the top. And I just kind of look at it. I click into the charts if I want to see if it is getting closer or further away. Now, most of the time I'm just waiting, I'm just looking, and I don't do anything because I'm fully invested. So this is like 2 minutes. And I look at it every day just to make sure that it's on the right track and it's not doing anything crazy. And if it is doing anything crazy, then I want to know why. Now, if it is not 100%, then I'll do basically the steps within Investing Accelerator, which is you sort through the list, and then you see if there's an opportunity. And when there's an opportunity, like it's on a discount, it's forming a bottom, you see some sort of pin bar or whatnot, then you do your research, which is the fundamental analysis part, the ratios, the insider. So when you're looking at this, you are sorting through your list maybe once a week, and then you just look at your top 5 to 10 stocks that are kind of on a discount to see how the price is changing. So this will maybe take 1 hour a week when you do it the first time, and then afterwards it's just a matter of 5 to 10 minutes to kind of look at it. And if you do see something you want to research, chances are you will find 1 to 2 companies that you want to buy, like Canadian Goose and Aritzia. And at that point, just spend around 1 to 2 hours to research on it. So it's around an hour stock. I can usually do an analysis in 30 minutes or so. So yeah, so that is really what I do on a weekly basis. And because right now I'm fully invested, I don't really need to do research day to day. I just wait till the weekend where I'm doing research for the community. Okay. So in terms of finding new stock ideas, I really pay attention to the news. So actually, I don't even pay attention to the news that much. When you open Chrome, you actually get some headlines, and sometimes they talk about investing. Maybe a new stock has IPO'd, maybe there's some disastrous event that happened. And then at that point, you would think, well, what kind of opportunities are available based on that event? So if it is a plane crash, then you would think about Boeing. If it is an oil crash, you would think about mining companies and oil and gas companies. And if you are thinking in terms of that way and just looking at the news, just doing very basic stuff, then naturally you will have a list of 50 stocks or so. Now, if you're really struggling with finding new ideas and you want to use a stock screener, because one of my students actually asked me for it, you can actually try finviz.com. And it is kind of a visualization website that allows you to see what are the biggest companies in the market, and they separate it by industry. So based on your industry, you can actually see what are the big companies, and then it's going up or down. So then you can see whether there are any that you recognize, and you can add them to your portfolio, to your stock list. So then you can track it that way. But then, yeah, I don't really add stocks using that approach because I already have like 50 to 60 stocks that I'm tracking. And recently I added Slack and Uber. So Uber just IPO'd and Slack just IPO'd. And if you invest during this time, you'll actually find that it's very, very volatile. You know, the price is moving quite a bit, so I don't invest until 2 years later. But I just put it on my list for now, and then it just kind of matures. And when I'm sorting through the list, I'll see it, and it will be at the bottom because right now it's not ready yet. So this is pretty much it in terms of the live Q&A session for today. I'll find another time to host another Q&A session, maybe next week or the week after. And then we can do this again. And I'll also share my screen next time because it'll be a lot more helpful if I do that instead. So thanks again for coming. If you have any questions, you can always submit it through the Google form. I actually answer every single question. And yeah, talk to you guys later.